Do you think we'll get the inverted yield curve in the United States?
Good morning. I think it's absolutely possible. After all, as your graph shows, we're only 9 basis points away from that becoming a reality, and indeed, shorter in on the curve, it already is a reality. So I don't think that on its own is a game changer. I think we're already in an environment where people are talking about and very well aware of yield curve inversion, and clearly more disappointment out of earnings revisions and changes to outlook at a corporate level. Combined with the lack of progress on the Chinese trade war negotiations are only going to continue to compound this.
Are we misreading bond yields? We assume it means that the world is going to head to recession, but given all the negative yields around the world, especially in Europe where you are with a 0.5 negative yield in the German Bund, maybe is the bond market simply telling us there's nowhere else to go? Is it a recession sign, or is it just a lack of other places to invest?
I think compared to previous cycles, the government bond area is much more of a relative value game than it used to be. It's more of a global game, and so clearly the levels of government bonds in Europe and indeed in Japan have much more of a consequence on what you guys are going to be experiencing in America. That said, I think that if anything, it's more the equity side that is not fully reacting to some of the disappointing earnings data and political headwinds that we're facing globally here. And I'm actually quite surprised that you haven't seen more of a reaction on the equity side to what these yield curves are telling you. After all, I think a lot of the ways that companies are likely to defend themselves as earnings deteriorate involve things like cutting dividends, cutting back on share buyback programs, selling non-core assets, and other things like that, which are not necessarily great for the equity stock price in the short term.
What's the most important thing that you're watching in the world right now, Fraser?
So I think one of the most interesting things right now is that if you look at the low end of the fixed income space, in the low end of the high yield market, for example, it's having a really horrible time. And that's because no amount of monetary or fiscal stimulus is going to be enough to keep some of these essentially structurally impaired, over-levered companies from having to restructure. And so you have this unusual scenario where even though total returns in mostly everything that I look at are very positive year to date, the lowest part of the market is continuing to have a horrible time. And I think we're spending a lot of our time continuing to try and understand that.
Yep.
Because I think you are likely from here to see default rates tick up, and subsequently I think you're going to see lower recovery rates than you've seen in the past.
Fraser, Lundie.
That's something that I think is really worth watching an eye on.